Alright, so today I wanted to make a video on a new stock that I don't think I've ever made a specific video on. This is HIG, Hartford Financial Services Group. So they are an insurance company, $31 billion, so fairly large, not gigantic, but fairly large. Earnings yield 9.6%, which is really good. They're paying just under a 2% dividend yield. Let's get right into some of their insights here. Profitability, they're decent. I mean, a 14% operating margin, 11% net margin. The growth is fairly good. They're growing well. Financial health is also very well. This is actually really good. And then if we look at the dividend, I'll get into the dividend a little bit. They're projected to grow earnings 16% next year, revenue 11%, which is also good, and they are below their historical PE, which I think is also very good. Especially like they're projected to grow their earnings, I think around 12% over the next 5 years per year, and I mean I think that's even a little bit more than the S&P traditionally grows, and they're trading at a 10 PE, which is I think it's a little under half of what the S&P is currently growing. So that's why one of the many reasons I really like this company is and not to mention too, they have outperformed the S&P over the last 5 years. So this is a company that I think will outperform the S&P and trades half as expensive. Like this is a true value play, at least in my opinion. Let's get into the financials here. If we look at, actually this is the metrics, let's get to the income statement. They've grown revenue, I mean, fairly consistently. I mean, going back to 2017, it's pretty much a consistent step up, although they haven't grown super quick. If we look at their shares outstanding, this is where they're really shining. I mean, going back to 2020, starting in 2020, they had 361 million shares outstanding. They're down to 297 with, ending the third quarter 2024. So that's like 4 or 5% a year. They're buying back just in shares, which is really good to see. If we look at earnings here, going back to 2020, 472 a share the last quarter of 2024, at least the third quarter, 1017. So they've basically doubled their earnings over the last 5 years, which is really good to see. If we get into the metrics here, let's check on these. These have also consistently gotten better. Go back to going back about 3 or 4 years, they've consistently gotten better. They're trending up ever since then. They were actually negative, but that was like 7 years ago. And then if we look at return on equity, return on invested capital, those numbers are both near all-time highs. I mean, looks like return on equity, the highest it's ever been, a little over 18%. That was the second quarter of 2024. Return on invested capital also right near an all-time high. So that's exactly what we like to see as well. They've grown their dividend about 10% per year, but if you look at the payout ratio is actually going down ever since 2022. It's actually going down, even though they're growing at about 10% per year, which is really good to see. Revenue per share, like I said, just consistently going up. That's exactly what we like to see there. Speaking of the dividend, one of the things I also really like, they're paying almost a 2% dividend, but the payout ratio is not even 20%. They're growing at 10% per year, which is exactly what I like to see. Buybacks 3-4% of shares per year, grow your dividend 10-12% per year. That's exactly what I like to see. This is almost perfect as far as that goes. And then if we look at analysts actually, the lowest estimate has it about 11-12% above where it's currently trading. The average is about 21%. And the reason that I'm talking about this now is that it has had a fairly sizable pullback from its high back in, looks like the end of November. It's down about 12% since then. Although it is, if you go back a year, it's going to be up probably 30%, roughly, 31%. So that's exactly what I've been waiting for. I think I noticed this company, I think it was like probably, September, October of last year is when I really started watching it, and it has pulled back to the point to where I started buying it probably a couple weeks ago or so. I think right after this big pullback. So this was late December. That's when I started buying it. And I do think it's a buy right now. If we get into those numbers, let's get into those numbers just to see where we're at. So if we go back about 5 years, like I mentioned, they've grown earnings about 16.6%. They've only grown revenue about 5%, which I wish that was a little bit better. But if you look at return on invested capital, they've grown that 7% per year, which is good to see, because there's a lot of companies that they don't grow that at all. If you look at earnings, compounded annual growth rate to their earnings has actually gone down, which kind of puzzles me because they performed extremely well. But in my opinion, that's just a good sign. If we look at their 5-year average PE, it's 10.72. It's currently at 10.46. So I definitely think that this company is trading at a discount right now. Like I definitely think that. So let's get into the valuation. This is just the discounted cash flow calculator that I put together. So if we look at their numbers here, I'm projecting them to grow earnings at 10% per year, which is less than their 5-year average of about 15 or 16, and less than the 12% that's projected, at least based on the numbers that I've seen. They're going to buy back 3% of their shares. They're going to grow their dividend 10% per year, and they're going to trade at a 10 PE. That implies fair value is 41% above where it's currently at. That might be a little bit aggressive, but when I look at these numbers, I don't think any of these numbers are crazy unrealistic, even unrealistic at all. So I do think this company's trading at a very clear value right now. I would be buying it. Honestly, I probably would be buying it just based on these numbers. I'd probably be buying it near 130, 140 a share. And I mean, they got up to like the mid 120s recently. Like 125 is the high. So I think this is a clear buy where it's at right now. The one potential problem is that it's in a little bit of a consolidation period here, so it very well could go lower if the stock market goes lower. If there's a recession, it definitely could go lower. But long term, I think that a stock like this is a no-brainer. I don't think you're going to get rich off it. I think that's part of the reason why it's sold off and why people don't like companies like this. Like, you're not going to 10x your money in 5 years or even 10 years like you could with a artificial intelligence or like an NVIDIA or something like that. But I do think that it's a buy, right? Because when you look at these numbers, I don't think any of these numbers are unrealistic. They've bought back 4% of shares. I'm projecting them to buy back 3%. I'm projecting them to grow less than what they've historically grown. I'm projecting them to grow their dividend pretty much exactly what they've historically done, which I think is easily doable given the payout ratio is like 20%. And they're going to trade for a 10 PE, which is also a little bit below their historical average. So I think that this company is clearly undervalued. I think that fair value is probably like 130, 140 a share, debatably higher based on this. But I think that it's clearly undervalued. I think that the market also might be pricing in a little bit of a slower year, at least when it comes to the market. So I think that that's part of the reason. But I think that this consolidation period, regardless of how long it lasts, once it gets out of that, I think it's going straight to a new all-time high. And I think that number is probably 130, 140, 150 a share. Is it going to happen this year? I don't know, but it's going to happen because companies like this, they have very steady businesses. They're very quality businesses. I've talked a lot about insurance companies before, and it's not that all insurance companies are good, because there's a lot of trash ones. It's just the good insurance companies are worth their weight in gold because they make money hand over fist, and it's a fairly stable business. So this is another example of one that I really like. If I'm talking about other ones just off the top of my head, I think there's 4 actually that I'm currently buying. Primerica is another one. KNSL is one that I'm buying. They've pulled back recently. I like them. And then there's WRB. Those are the ones that I like. I'd have to dig a little bit deeper to know the ones that I like the most. But honestly, this is the one that I have the least, the smallest position in, which is why I'm talking about it now. So anyway, that's what I wanted to bring up today. If you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.